Hello and welcome to the Tax Roundup for April 2014. And what an interesting few months it's been. On the one hand, the government seems to be actively pursuing efficiency, and with the repeal bill, they're removing around 1,000 pieces of redundant legislation. And at the same time, the ATO just seems to be increasing complexity. One of the big issues this month is dividend washing, with the release of draft legislation to prevent the double dip on franking credits, and also the ATO's active pursuit of this issue. Adnan and Sibai explains.
Now, the ATO is really gunning for taxpayers that have entered into something called a dividend washing arrangement. Now, we've raised these in previous tax roundups, but basically it looks at a scenario where a taxpayer sells and then repurchases shares around ex-dividend date to allow them a double dip in franking credits. Now, we mentioned that the ATO doesn't like them, the government doesn't like them, and they're actually proposing a law that will be effective from 1 July 2013. All this changed and the ATO is not happy. They've actually sent out letters to taxpayers saying that they still think you need to go back before 1 July 2013 to review your arrangements and see whether you've claimed a double dip. Tricky problem here is this problem doesn't come up when you're preparing a tax return or just summarising a client's income for the purpose of preparing the return. You actually do need to look further. You need to interrogate or talk to the client, see what happened or what transactions they made during the year. And even the client sometimes doesn't know, because this is something that's done by their stockbroker or financial advisor. Okay? Ultimately, the ATO's on a warpath. They're sending out these letters. Do talk to your clients and don't ignore the letters when they do come out. This is definitely a hint at further audit activity or investigation, and you do need time to talk to the client and their advisors to unravel what happened in prior years.
But there is some good news from the ATO. They've announced an amnesty on foreign income. Mike Carruthers explains.
Now, one of the other big items that's come through in March is the ATO's announcement that they will be running an amnesty program in relation to foreign income and foreign assets. Now, we have seen limited versions of this sort of thing in the past. We've seen other countries, for example the US, quite recently offer a similar type of amnesty. And what the ATO is really trying to do is to bring everyone who may be on the fringes of what the tax legislation requires well within the system. So the ATO is potentially giving up some revenue for previous years, potentially giving up some penalties and penalties that could be applied in exchange for getting people back within the system. That's the main idea here. Now, the key date is 19 December 2014. That's when the amnesty period will run out. So we do have a bit of time to start talking to clients, start identifying those clients who potentially could benefit from this. The tricky bit with this is there might be clients who could benefit from this, but you've got absolutely no idea that they do have foreign income or foreign assets because they've never told you. So it might be the chance to put the word out there that the amnesty is being offered by the ATO, set out what the benefits of that are, and that some action does need to be taken throughout the next 6-8 months or so. Now, the benefits of being part of this program that's being run by the ATO are, firstly, that when you come forward, it will be treated as a voluntary disclosure. That will have the impact of reducing, or at least putting a cap on the penalties that could apply. So if there is a shortfall of tax from prior years, the penalty component will be capped at 10%. If your undeclared income from prior years is under $20,000, then there will be no shortfall penalty at all. So that could be a significant saving where someone has underpaid tax in prior years. The penalties potentially could be much more significant than that. Now, important to note that general interest charge would still apply. So there'll still be an interest component, but the penalty component could be significantly lower than it would otherwise be. Now, the other benefit here is that the ATO will only go back as far as the amendment periods are open. So for a lot of people, that would be a four-year amendment period where they do have offshore assets or income of any significant amount. And one of the other key benefits is that any cases that are accepted through this program won't be referred as a criminal matter. So taking that completely out of the equation, there might be people there who are just not quite sure whether they do have an issue, this is really the time to get it resolved, even if it's a matter of just discussing it with their accountant and figuring out whether there is a potential liability or not, and then coming up with a strategy to approach the ATO or don't approach the ATO as part of this process. Now, the ATO has also indicated that you could potentially have a chat to them on a confidential basis without providing details to see whether clients are likely to be accepted into this program. Just get a feel for how the ATO is likely to sit with the particular situation that your clients may be facing. So the opportunities there, the ATO have kind of put it out there. As I say, they're potentially giving up some revenue that they could otherwise be raising later down the track if they kind of go through all the typical enforcement procedures. But 19 December this year is the key date. Need to take advantage of this by that date if that's something that clients think is of benefit to them.
For members of Knowledge Shop, we'll be including an article on the foreign income amnesty on the next client newsletter we write for you. Don't forget to download it from the members area of the website. Finally, this month, we're looking at a radical proposal from the Board of Taxation on the operation of Div 7A. Mike Carruthers explains.
Now, you may recall that the Board of Tax has been asked to undertake a review of Division 7A and just see whether it actually is achieving its purposes. The Board of Tax has just released a second discussion paper, and this paper actually includes some fairly radical changes to the way that Division 7A would operate. And it's worth just touching on what some of the key recommendations are. So at the moment, we have a different set of rules applying for loans, payments, use of company assets, and forgiven debts. What the board is suggesting is that all be consolidated into one pretty single set of principles, which can only be a good thing, I would say. There would also be some changes to the way the distributable surplus rules operate. So at the moment, it's always a little bit uncertain as to whether we have to go out and revalue assets and to what extent that needs to be done, what sort of evidence is required. The board is suggesting that the test is focusing on realised profits only, rather than having to bring into account potentially unrealised gains as well. There's also some suggestions to improve some clarity and provide some certainty around unpaid distributions to corporate beneficiaries, and this has been a big problem area for practitioners and clients over the last few years since the ATO changed their position on this topic a few years back. What the board is suggesting is that where an unpaid distribution is owed to a corporate beneficiary, that the rules be clarified to confirm once and for all that at an appropriate point in time that is treated as a loan. So a loan from the corporate beneficiary back to the trust. However, the second part that they are recommending is that the trust be able to make an election. And what that election would do is allow that loan from the company back to the trust to avoid triggering a deemed dividend under Division 7A. But the flip side of that would be that the trust, in making that election, would be choosing to give up its entitlement to the CGT discount on capital gains made on assets, except for goodwill. So treating the trust a little bit like a company. Now, what will be interesting to see down the track is when the government undertakes its whole review around the rules around trusts and taxation of trusts, how that will interact as well. So something just to keep an eye on in the future. Another thing that's worth mentioning is really common way that people deal with Division 7A loans at the moment is to put complying loan agreements in place. The two main options are a 7-year loan or a 25-year loan term. What the board is suggesting is that be scrapped and be replaced with a single 10-year loan term. But that 10-year loan term would have some flexibility built into it. So flexibility in the way that principal repayments are made over that 10-year period. So you're not necessarily locked into making certain level of principal repayments each year. You'd have some flexibility as to how that occurs over the life of the loan. So some really sensible options and recommendations being made by the Board of Tax. They are now seeking, and Treasury seeking, some comments, submissions around the process. But the next stage will be the difficult one. How does that get translated into draft legislation? Are we able to actually get that through Parliament? And what will the end result be at the end of the day? Because that's what we really care about. So something to keep an eye out for. Potentially it might lift and remove some of the headaches that we all deal with on a day-to-day basis. And if that's the case, then that's a great thing, but that might be a little bit down the track. Let's wait and see.
And that's the tax roundup for April. Don't forget, if you're a member of Knowledge Shop, you can download the full FBT compliance program from the knowledge base right now. It includes the client questionnaires, the standard letters, the procedures, the processes, the checklists that you need to get through this particular period of FBT compliance, and hasn't there been a lot of change? If you're not a member of Knowledge Shop, then why not give Ray a call on 1800 800 232 and have a look at what we have to offer. See you next month.